Most traders look at a flat, sideways market and see a dead zone, a place where capital goes to bleed out in endless chop. But under the surface, price is still swinging wildly. It's trapped inside a ping-pong box. The price is continually bouncing between a fixed support floor and a fixed resistance ceiling. This environment often punishes impatient traders. They try to predict a massive structural breakout, buying near the top or shorting near the bottom, only to have the price snap back into the range. Professional traders ignore the macro trend entirely and zoom in. They look for micro-oscillations, predictable swings that are hidden inside the noise. Trading a sideways market requires a shift in strategy. Success here relies on capturing the immediate bounce, using a mathematical anomaly called hidden stochastic divergence. Step 1 is adjusting our field of vision. To capture these micro-oscillations, we drop down to microscopic timeframes, specifically the 1-minute or 5-minute charts. We track this momentum using the Stochastic Oscillator. However, using the standard factory setting of 14:3:3 is often ineffective. That setting is designed for slower moves and lags too far behind fast price action to be useful in this environment. We require an aggressive calibration. By changing the input to 5:3:3 or 9:3:1, we create a reactive indicator that perfectly catches these sharp, sudden V-shaped drops. This aggressive setup strips away the smoothing. It exposes the raw micro-momentum of the market, reacting the moment that buying or selling pressure shifts. Calibrating the indicator to this frequency allows the data to react to momentum shifts before they become obvious in the price candles. This schematic outlines our boundaries. Watch when price drops toward the support floor. It attempts to drop, but stops short, hooking upward to create a higher low. Meanwhile, the stochastic violently plunges into a deep lower low. The math contradicts the price action. Think of the indicator like a child throwing a tantrum, screaming that the downward momentum is huge, but the parent, the actual price, is ignoring the noise and holding steady. This is a liquidity sweep. Sellers are exhausting their supply to try and break the floor, pushing the momentum indicator to its extreme, but there isn't enough weight to push the price down with it. When momentum crashes but price refuses to follow, the market is primed for a move in the opposite direction as that pressure is absorbed. Spotting the divergence is only the first step. If you enter the market the second it appears, you are still guessing. We need mechanical confirmation. Your first mechanical trigger happens on the oscillator. Wait for the fast blue %K line to cross up and over the slow orange %D line. This cross must happen low on the scale, aggressively piercing up through the 50 level. This confirms upward momentum. Your second trigger is a price action signal. Look for a bullish engulfing pattern or strong pin bar exactly as the indicator crosses. Now apply the risk protocol. Place a tight stop loss below the wick of your higher low. Breaking this invalidates the setup. Waiting for this dual confirmation, the momentum cross and the candlestick trigger, is what separates precision from gambling. It ensures you only enter when the buyers have clearly taken control. When the setup works, the reaction is fast. The price moves from the support floor straight back to the resistance ceiling. This is your exit point. Take your profit immediately at the ceiling. Do not hold the position in the hope of a breakout. Success in sideways markets requires discipline. You enter the bounce, capture the profit, and exit immediately, before the market rotates. Practice this sequence on a demo account. The rhythm of the ping-pong box needs to become familiar before you put capital at risk. Developing a technical edge allows you to find opportunities in markets that others avoid. By focusing on these micro-oscillations, you can systematically extract value from the range, while the rest of the market waits for a trend that may never arrive.